what are term sheets and what are the specific provisions found in those term sheets? To begin with, a term sheet is simply a document that memorializes the terms agreed to between the startup founders and an investor in the startup. So when an investor is looking to invest capital in the startup in exchange for an ownership interest, the founders or the management or leadership team of the startup will negotiate with the investors, and whatever they come up with is generally memorialized in the term sheet. And this term sheet is then used to create the specific legal documents needed to carry out the transaction. Generally, the term sheet is not enforceable. It is simply a statement of common understanding. So what are the common provisions? Number one, what are you valuing the business at? Because this will determine what percentage the investors get for the amount of money that they provide. So if you value the business at $100 and investors are providing $20, they will probably want 20% ownership in the business. So that's an important figure. Resulting capital structure, meaning how is this going to affect the current capital structure? Is there going to be an issuance of new shares? Is there going to be a forced exercise of all the options? Are they going to reserve a capital pool or option pool for incentivizing management or third parties as part of this process? So that's a common point of negotiation. Specifically, the size of the option pool is often a very important point to note. The type of security that the investor is going to receive. Investors generally don't want common stock that's on equal footing with existing founders. They'd rather have a preferred type of share, and it's generally preferred convertible participating shares. And so let's look first at what this means. Generally, these types of shares have a liquidation preference, meaning that the investor puts in money. In the event that the company sells, the investor will receive back a certain amount of money before any other investor receives any money. So upon liquidation, there's a preferential payment or preference of payment right to the investor. Oftentimes, the liquidation preference is 2 times, 3 times the amount of investment. So the investor is going to make money on the sale of the business before anyone else does, based upon the liquidation preference.